Hello, and welcome to the Three Questions podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. Now, if you or someone close to you find the U.S.-Canadian cross-border tax planning a little bit more complex than you'd like, well, this episode is for you. Stay tuned. Our topic, the three questions cross-border tax filers need to ask before completing their 2024 tax returns. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions podcast, please consider liking this video and subscribing to our podcasts and YouTube channels. Welcome to another episode of Three Questions with Wayne Baxter. Today, we're going to dive into the world of cross-border tax planning with our guest who specializes in the world of U.S.-Canadian cross-border tax planning. Joining us from beautiful Vancouver, British Columbia is Steven Flynn. Steven is a partner CPA and a CA with Andersen. Steven's work focuses on cross-border tax matters, including investments between Canada and the U.S. by both individuals, businesses, and U.S. citizens residing in Canada. Our topic today, the three questions cross-border tax filers need to ask before completing their 2024 tax return. Steven, hello. Great to see you. Thank you so much for this is a busy time of the year for you, so thank you for making time for us today. Appreciate it.
Wayne, happy to do it. Good to talk to you again. I look forward to helping your listeners out and answer some of your three questions.
That's for sure. Well, you know, I got to say right now, I could dive right into the questions, but I think I would be putting the cart before the horse here a little bit. Before we get to the questions, I think we should probably acknowledge that we're in right now navigating into some really uncharted waters for individuals and businesses who have ties to both the U.S. and Canada. And of course, I'm referring to the ongoing trade dispute, my words, between the United States and Canada. From an investment perspective, at least in the short term, the actions there and rhetoric that's being taken by the Trump administration here in the U.S., however well-intended, has created uncertainty. And I'll tell you right now, probably the word uncertainty has been used more in the last 2 weeks than in the last 10 years. You know, and markets hate uncertainty, and we're seeing market volatility. One day the markets are up 1.5%, the next day they're down, the next day they're up. And that's all thanks to just a lot of uncertainty. So I was curious to know if and how you and your colleagues at Andersen, you know, and in the tax planning world, maybe in general, have been impacted. You know, not so much obviously with regards to our topic, with regards to 2024 tax filing, but what about tax planning with your clients for this year and beyond?
Well, it has an impact, Wayne. You know, when you have this kind of uncertainty, to use that word, and this kind of conflict, you know, it causes individuals and businesses to really reflect on where they're at and what, you know, they should be doing. And that could be from a tax and a non-tax perspective. You know, we've seen a number of different situations with our colleagues, with some of our clients, with some of our prospects. And, you know, two kind of stick out here. One is, you know, from a Canadian perspective, you know, there are Canadian businesses that have a significant impact when tariffs are imposed. They are big exporters to the U.S. market, and they look to say anything from, well, if we're going to stay in Canada, what types of, you know, structuring, looking at transfer pricing of either, intellectual property or trademarks or patents, or, you know, what can help us, you know, lower that tariff and help us continue to sell to the U.S. market, which is so important to us. Or in the extreme, you look and say, you know, should we still be in Canada if we were across the line? And it could be in Eastern Canada, where you go from Quebec to, you know, some of the border states. It could be in Western Canada when you go from British Columbia to Washington State or Idaho. Or you know, Montana. It's, you know, if we're across the line here and we're manufacturing in the United States, what does that look like? And there's a, you know, a fairly sizable expense to trying to do that. But long term, if that's what your market is, these are the conversations people start to have, and it has a real impact. So that's one. The second one, I think, is an interesting one that we work with a lot of U.S. citizens resident in Canada. Our firm does a lot of cross-border taxation, both for business and individuals. We've had a number of inquiries, probably since the election last year, but certainly increasing of American families, U.S. citizens, who may be from Canada originally, or they've never been to Canada, who've said, you know what, it's time for me to seriously consider moving from the U.S. and becoming a resident of Canada. And it could be any stage of life that they're looking at. It could be employment. Oftentimes they're retiring. Oftentimes they just look at the situation and say, I don't want to be here anymore. And Canada looks a lot more attractive. And so we're seeing those two types of situations and amongst many others.
Interesting. I think on the first one, you kind of hit the nail on the head because where I was kind of thinking is that if you're a Canadian entrepreneur, a business owner, and you're manufacturing a widget that could be exposed to tariffs, and basically the current administration says, well, if you build that widget here in the United States, there's no tariffs. And you can't help but think that, like you said, there's an initial upfront expense of, establishing a presence on south of the border. But after that, does it make sense business wise? Okay, is the upfront capital cost of as getting your footprint south of the border, how does that look when you compare to a potential 25% tariff
Right.
on your product?
Well, and tie to that or add to that the complexity from a taxation perspective. We'll talk a little bit later about exit taxes in Canada. We don't let you just leave tax free. There's a departure tax in Canada. At the same time, there's immigration issues. If you want to move your senior key people from Canada to the U.S., they have to have some sort of status to work in the U.S. And I think we've all been reading how difficult that seems to be for people outside the United States to become, visa holders or go in and out of the U.S. with status or trying to obtain status. It's becoming very difficult. So.
Well, I love the way you either intentionally or inadvertently segued into the role that we play here at One Capital. I got to say, I mean, I would say I spent a good part of my time working with families, trying to figure out, literally ongoing all the time, asking those both questions. Should I relocate to the U.S.? I'm working on some cases right now where that's in question, and also always talking to people who are wondering, and oftentimes it's like you discussed, people who have been living here for many years, originally from Canada. They moved down here, they worked their whole career, and now, case in point of a family I helped move from the Bay Area back to Ottawa, and they lived there for 25 years in the same cul-de-sac, raised their families, had friends forever, and all of a sudden, one by one, their neighbors started moving away. Right. And one day they're sitting there and they're all by themselves, and they don't know anyone on their street anymore in their cul-de-sac. So, they said, why are we here? So, and we ended up, it took us 2 years to do all the planning and processing, but we helped them relocate back to Canada, which is where they are today. Actually, just met with them yesterday for our quarterly review meeting. So, I will say this, the planning process before, whether it's to move south of the border and whether you're moving senior management, it's not a do-it-yourselfer exercise. I can tell you right now, I'm sure you would agree with me on that. I mean, at the beginning, obviously, we have to have an immigration plan. We have to figure out the immigration strategy if you're relocating and who's relocating, and not just the individual, but their families. To think about that, does that make sense? How are they going to do it? Do they intend to be a temporary or permanent move? And then the next move is obviously to bring in a tax expert like yourself, your team, to figure out the tax implications of relocation. And then beyond that, then you get into even more planning, capital forecasting. How does financial planning look as a U.S. resident compared to a Canadian resident? What type of assets should remain in Canada? What should you be bringing with you? And then you get into estate planning, risk management. What's the real estate strategy? How are we going to finance a purchase of a property? There's so much more risk in the U.S. too when it comes to litigation risk as well. So there's lots to talk about and think about before a relocation.
Absolutely.
So, and for someone looking to move to Canada, there's also a whole bunch of factors that you have to think about depending on what state you're coming from. If you come from a no tax state moving up to Canada, it's something you want to figure that out from a tax perspective of how that's going to look. And also, how well protected are you going to be in terms of healthcare, depending on what part of the country you move to. So it's an interesting conversation and one that I have all the time. Okay, you know what? I think we covered that pretty well. We're going to be discussing the 3 questions cross-border tax filers need to ask before completing their 2024 tax returns. And our questions that we've posted today are from the perspective of cross-border tax filers, either in Canada or the US. So, Stephen, you ready to go?
Oh, absolutely. Sure. You
Okay,
bet,
so
Wayne.
question number one. Is Canada tax similar to the US? And if not, what are the differences? Stephen,
Sure.
take it away.
Well, I can, and there are some similarities between the two systems. Canada, like the United States, is a self-reporting system. Individuals will file tax returns if they're resident of Canada on their worldwide income and the income from their worldwide assets. If they're U.S. citizens, it's the same. It is the differences though between the two countries that really stick out and are really important. And one of the from an individual taxation perspective, one of the biggest things that people have to face and understand is that Canada's income tax system results in, generally speaking, higher tax rates on almost all types of income. And so,
Mhm.
for example, if you take that family that lives in Washington State, and just in your example before, where there's no, state income tax except for capital gains, but let's just say there's no state income tax and there's a federal tax, and that top marginal rate federally right now is 37%. Well, in Canada, when you combine the federal and provincial rate and use British Columbia, for example, here, that top marginal rate is 53.5%. So right off the bat, it's a 16.5% difference. But more importantly, it's where that top rate starts.
Exactly
So in the
right.
US, yeah, in the US, as you know, it can start anywhere from kind of $400,000 to $650,000, depending if you're single, married, filing separate. But in Canada, and this is in Canadian dollars, not US dollars. You hit that top marginal tax rate at about $265,000 Canadian, and so it's a big difference there. The other difference from an
Around
individual,
$180,000 US, by the way, just to clarify.
well,
When you convert to US dollars.
it
So it could be
is,
a
and
difference between 180 and $600,000. It's quite an eye opener.
well, and it is discouraging for us in Canada to see that there, and going through some exchange rate differences for some of my clients that are starting to sell U.S. properties as we go back in time. There was a period, and it was about 4 years from about 2009 to 2013, where we
Remember
were
it
at par.
well. Remember it
we,
well.
we were at par for about 4 years in there. So yeah, it's a spread. The other piece to that, though, is for families is, U.S. citizens who are married can file what's called a joint tax return. They can combine their incomes together on one tax return. There's an advantage there in that the combined tax rates can be lower. And so if you have a high income spouse and a low income spouse, when they put themselves together as a married couple, they can lower their federal and their state tax rate. Canada does not have that concept. Each individual has to file their own tax return.
Mm.
And so when you have that situation where you have a high income spouse and a low income spouse, you're going to get very different results because the high income spouse is taxed on everything themselves and really can't take advantage of the fact that the low income spouse is in a lower tax bracket. And yes, there's some credits that transfer back and forth, but that doesn't make a big enough difference. So that's the first piece there is, in general terms, our tax rates are higher. That's not true with every piece of income. For example, stock options in Canada can generally be taxed at lower tax rates in Canada compared to the US. There's incentives for those types of things. But in general terms, our tax rates are, Wayne, quite a bit higher.
So maybe you could take a couple of minutes before we go on to our second question, Stephen.
Sure.
How do the two countries handle taxation of capital gains? You talked about different types of income. How do the two countries handle taxation of capital gains or retirement income differently?
Sure. So I'll take on capital gains, and so there are some similarities. Canada has some lower tax rates than that 53.5% on capital gains, and so in Canada, if you have a capital gain, our top tax rate is one half of whatever the top rate is. So if you just take that top rate of 53.5% in British Columbia, if you take half of that, our top marginal capital gains rate is 26.75%. And there's some nuances there with alternative minimum tax. If you get into really high capital gains, that can increase that rate up to the early to mid 30%. But if you just take that rate without alternative minimum tax, that's somewhat comparable to the US federal long-term capital gains rate, which right now is 20%. And if you have a big enough capital gain in the US, you have the net investment income tax, you had another 3.8%. So if you're trying to kind of compare apples to apples, it's not that much difference in the US compared to Canada. There are some slight differences though. The US has a concept that to get that low rate, you have to hold that capital asset
For a
for at least a
year.
year. Canada doesn't really have that concept when it comes to equities or stocks. You can have long-term capital gains if you hold a stock for a month. If you hold other types of assets, real estate, for example, that you sell within 1 or 2 years, Canada can tax you as regular income, as ordinary income. We've got some new rules that are associated with that. So it really depends on the type of capital asset. So the rates are similar and the treatments are generally similar. It For families that move back and forth across the border, though, you can have some very different cost basis amounts, if you will. And just to give you one example of that family that moves from the U.S. to Canada, if they haven't lived in Canada before, or even if they haven't, but weren't residents of Canada for a long period of time, when they become residents of Canada, their cost basis in a lot of their assets, stocks, equities, things that are on registered accounts, U.S. real estate would be a good example, isn't the original cost basis they have when they bought that asset a long time ago. It's the fair market value of whatever it is when they came to Canada. So Canada is really only taxing post-move appreciation. And those differences can really help families when they're coming to Canada saying, okay, well, I know I got higher tax rates and these currency differences and everything else, but they're only going to be taxed on post-move gains on a lot of their capital assets.
But you still have to report the IRS though when if you didn't give up your green card, if you say you're a permanent US, well, if you're a US citizen going to Canada, you still have to report to the IRS based on the US cost basis.
You do, but let me give you one of the magic ideas that we see from time to time. You're absolutely right if you're a US citizen. If you're not a US citizen, and we've seen this situation time and time again where someone goes to the US on a visa, some sort of category. They are residents in the U.S. for a long period of time. They have a significant appreciation in either equities or maybe it's their own business or something that if they leave the U.S., they probably don't have an exit tax because they're not a U.S. citizen. If they weren't a green card, they can get away. There wouldn't be a U.S. exit tax. Depending on the type of asset they have, and equities and stock investments in stock market would be one. Certain types of businesses could be another. It may avoid U.S. tax on a sale if you don't live there, but because Canada is only going to tax you on post-move appreciation, you might find that you escape taxation both in the U.S. and in Canada, and perhaps in the state you were living in on the appreciated gain. You might have a tax-free gain, and that can be significant depending on the assets, depending on the situation.
Which is why right now, folks who are listening in or watching, why tax planning, cross-border tax planning is not a do-it-yourself venture. You need a creative tax expert like my friend Steven here. Most certainly not a do-it-yourself exercise. Okay, so let's go on to question number 2.
Sure.
If as a U.S. person and a Canadian resident, I wish to invest in Canada, what are the Canadian and U.S. tax considerations I should be aware of?
And there are plenty, and it goes back to your comment, Wayne, about cross-border tax planning and structuring being complicated and nuanced and very difficult to do on one's own. I'll give you 2 examples, and they can be from kind of the smallest thing to the biggest thing. And the perspective one has to remember that if they're a U.S. citizen living in Canada, they're subject to tax in both countries on the worldwide income. And so they're different from their Canadian neighbors who aren't U.S. citizens. Their Canadian neighbors and their colleagues might invest in something called registered education savings plans. So they're similar to 529 plans in the US. You've got young children, you want them to go to post-secondary education. You put some money in the account every year, it grows tax-free. It has some government matches. Your children then pay tax on the income and on the withdrawals when they go to university. It's a great setup for Canadian families. From a U.S. perspective, what it is if everyone's a U.S. citizen, it's a trust. And it's probably a non-grantor trust, meaning the parents put the money in the trust and the kids are the beneficiaries. And if that wasn't so bad, it's a foreign or a non-US grantor
Exactly.
trust. And so you get all sorts of, uh, you don't necessarily have a bunch of trust reporting rules anymore because there are some exemptions under the IRS for that. But when the kids go to school and start to take the money out, you'll have accumulated earnings tax, you'll have the throwback tax. You may have a situation where they're subject to tax in the U.S. on much higher amounts than, say, kids that weren't U.S. citizens, and all the way through, because of its nature, those assets are probably subject to tax in the parents' hands all the way through because of the U.S.'s rules on kiddie tax. And so, in the end, not as efficient a tax structure. There may be other ways to kind of do this. At the other extreme, though, you have a lot of U.S. citizens who come to Canada who want to form businesses. And one of the things we do here as entrepreneurs is we form Canadian corporations, and those Canadian corporations have a lower tax rate on kind of the first $500,000 of income if you've got a small business in Canada. Great from a Canadian perspective. There's a number of anti-deferral rules in the U.S., and one of them called the Controlled Foreign Corporation Rules. We'll look through to that corporation, and in certain situations, we'll pick up the income on the U.S. personal tax return. There'll be reporting requirements. You just really need to be careful how you set up your business in Canada if you're a U.S. citizen.
Okay, you've been in advising clients for several years now. If you go back and take a look at your experience of working with people, and usually, I know oftentimes we have to come in and sort of clean up messes, right?
Uh-huh.
A lot of either omissions or commissions that have taken place that have been adversely affected the outcome, the bottom line, if you will. So what's the biggest mistake that you see U.S. investors make when they don't account for the Canadian cross-border, U.S. Canadian cross-border
Yeah.
tax border, the cross-border tax rules? What would you say are the biggest mistakes you're
Well,
seeing?
I'd say one of the biggest, yeah, you talk about investors, and one of the mistakes we see often, particularly U.S. citizens who come to Canada who want to invest in the Canadian market, is they kind of do the same things that they were doing when they were in the United States. They look and say, okay, well, there's some index funds or money market funds or mutual funds that have a diversification. They have a return that they like. They have kind of an easy use. And so they try and replicate the same thing in Canada. And one of the concerns, we talked about some of the anti-deferral rules that the US has. Something Congress probably put in 40, 50 years ago was something called the Passive Foreign Investment Company Rules, or to use an abbreviation, the PFIC rules.
Yes.
And this catches people off guard because, in general terms, while a mutual fund organized in Canada, a Canadian corporation that replicates whatever investment direction you have, if it's formed in Canada, it's considered foreign from a U.S. perspective. If that mutual fund, and they pretty much all are, if they are basically ownership of other assets, of other companies, of other shares, then the assets themselves are considered passive. So you've met a passive in the foreign test, and as a result, what Congress says, it says, well, you must be doing this to avoid U.S. tax, and it's hard for us to get any information as to what the annual income, the annual distributions, capital gains on this. So it's a bit punishing. So the punishment is we're going to tax you in general terms on interest dividends, capital gains that you realize at the highest tax rate possible. There are some exceptions to that, but that's 37%. Doesn't matter what tax bracket you're in, but the U.S. will tax you 37%.
And if it's a capital gain where you'd normally pay maybe 22%, you're paying 37.
You're paying twice as much. There can be restrictions on foreign tax credits. So, Canada's going to tax that as well. And in certain situations, there can be restrictions or limits on foreign tax credits when you have PFICs. And so as a result, you're paying tax in Canada and you're paying tax in the US. When you add them up together, if you're getting over 50% tax rate, that's really inefficient.
On a
The IRS,
non-registered investment.
Well, that's right. And, the IRS wants details on this. So every fund you have, the IRS has a 4-6 page questionnaire that you got to fill in every year. If you hold these PFICs a long time, there can be what's called an interest charge. So if you buy it for $10 and you sell it for $30 and you've had it for 10 years, you've in Canada at least, you're only paying tax on that $20 gain in year 10. But the IRS and Congress say, well, no, wait a minute, you've held that for 10 years. You deferred tax for 10 years. We're going to charge you interest as if you sold kind of a proportionate amount each year. So it's none of these are good things. Uh, Congress and the IRS give you U.S. tax law gives you some elections you can make, whether it's publicly traded or private companies that fall into this, that effectively can bring in the income every year. So that is a solution. It can be an expensive solution. If it's a private company you've invested in, it might be difficult to get the information. You'd still have the reporting requirements. So it's something that just is worth discussion. And if clients choose that route, fine. But if there's other investment alternatives that can avoid the PFIC rules and get you a better tax result and maybe a simpler tax return, those can also be very attractive.
Yeah, you know something. I'm glad you brought the PIFA conversation up, Stephen, because it's something that obviously we became. Well, I moved down to the U.S. in 2012 and started my cross-border practice. It was one of the very first things that I was sort of indoctrinated on was the issue regarding PFICs, and we work very closely with our clients. We've developed some strategies that clients can implement, and it's applicable actually to Canadians also here in the U.S. If you're a Canadian. And, I'll give you the example. We work a lot with Canadians, and that we talked about it. The Canadian dollar has been hovering right around 69, 70 cents US. If you're moving to the US right now, and maybe whether it's an inheritance, maybe you've inherited money from Canada, or you're moving from Canada to the US and you have taxable assets, not your RSP or your risk, but your taxable money, and you're moving to the US on a more permanent basis, and you've got Canadian dollar that you ought to bring with you, but you don't want to convert. Now, the good news is we can actually bring those dollars across the border without converting. That's a great asset, that a service that we can provide that virtually no one else can. But the question is the PFIC risk. And if you have a well-diversified portfolio, it's going to include not only individual securities, but also, like you mentioned earlier, like ETFs, exchange-traded funds. So we've developed some strategies around that to keep the PFIC expense to a minimum, but it's something you definitely need to think about, whether you are a Canadian moving to the US or an American taxpayer domiciled in Canada. Definitely need to be aware of that, and not just. And one of the things that we see, I would say one last point, one of the mistakes that I see Canadians make is they will choose to just say, well, I'm going to leave my Canadian non-registered investments and my TFSAs, which no longer are tax-free once you become a U.S. resident. I'm going to just leave them in Canada. I'm not even going to bother. Well, there's a problem with that because you have to report them anyway. And if you're holding mutual funds, ETFs, segregated funds, even if they're in Canada, you still have to report them to the IRS. And I've seen
you're absolutely right, Wayne. Yeah. It's reporting the income, and it's fulfilling the disclosure. And the thing you always find difficult to see is someone who's got maybe 15 or 20 or $30,000 in these things, but has 4 different funds because they think diversification is that important. And all of a sudden it's 50 pages of tax reporting for it.
Steven Flynn from Andersen is joining us from beautiful Vancouver, British Columbia. And we're focusing on making sure that you're up to speed before you file your 2024 tax returns, whether you're in the US or Canada. Question number 3, Stephen. I want to leave the US and move to Canada. What are the Canadian and US tax issues? And boy, there are a few. Stephen, take it away.
Wow, there are a lot, and one of the things we'll talk about at the end is how you handle some of these, or kind of what are the techniques. But I got 2 in mind that I see families that cross them quite often, and one is just the difference of when you buy property that's your principal residence, your primary home, and the difference between the U.S. and Canada. And I said at the start of this that Canadian tax rates are higher than the U.S., and there are some exceptions. Well, principal residences are one of the exceptions. And so from a U.S. perspective, if you have a home and it's your primary residence, the first, if you're a married couple, the first $500,000 US dollars of gains is tax-free federally and tax-free in the States too. So, you might have a couple $1 million gain. You can shelter some of that gain, but some of it is going to be taxed. In Canada, as long as it's your principal residence and it's been that really your entire time that you've owned it, all of the gain is tax-free. 100% of the gain is tax-free. And this has been something that's been in Canadian law decades. probably going all the way back to 1971 to 1972 when capital gains were introduced. So, principal residence gains were always tax-free. It has been debated in Parliament, and political parties have discussed whether this is appropriate or not. It's a bit of a political minefield for a politician to say, hey, we're going to start taxing people's homes. So that's one of those advantages. And so you see people, buy and hold on to their principal residences and have that gain increase dramatically because it's going to be tax-free.
I guess if they were, if there was that, if they were that proposing taxing capital gains, they'd have to probably do what they do in the U.S. and allow for deduction of interest on the principal residence mortgages. I mean,
it's another distinguishment is that we do not I'm going to say general a lot because there's always exceptions. We don't generally allow a deduction of interest against your income taxes if it's your home, if the interest is related to that. There are strategies if you're an investor to move payments around, move loans around, make transitions so that some of the interest could be deductible. So there are some strategies that can help you with that, but that's right. That is one of the big differences. The other thing we see a lot from families, and whether it's California or other states that have high probate fees on death, is what they've done smartly in the U.S. is they've had their assets held in a living trust or an irrevocable trust that's formed under U.S. law, helps them avoid probate, helps their estate planning. That's great if you stay in California. If you move to British Columbia, that is not an effective strategy because now you're governed under British Columbia law and Canadian law, and so a U.S. trust isn't going to help you, plan for probate in Canada, but it's also going to be a trust taxable in Canada, and to the extent you've got a trust that's formed outside the United States, and if you're in the United States and you're now a Canadian resident, you'd have kind of filing requirements. You may have taxation rates. It's not an effective way. There are other effective strategies when you come to Canada to plan for your affairs and plan for your estate. And so, everything's just a little bit different. So those strategies you used, we often encourage people to say, well, that the living trust doesn't make sense anymore. There may be some other trusts, some other vehicles in Canada you should consider. And we always try and review those with them.
One of the more complex tax planning matters for Canadians returning to Canada after living in the U.S. For an extended period of time is determining whether or not they're going to be subject to a U.S. exit tax. And I'm thinking specifically of the green card holder who has been, they go down to the U.S. and this is what happens oftentimes. They go down thinking they're going to stay 2 or 3, 4 years, and then they're going to come back to Canada. And for whatever reason, things are going so well, they decided to stay, and they stay longer. And all of a sudden, they decide now is the time to go. And then they find out that they're going to have a bit of a surprise when it comes to exit tax heading north of the border. Maybe you could just highlight a little bit about what that's about and how it can be avoided.
So I think you're talking about green cards, that to the extent that you're a green card holder, and if you held it for a certain period of time, if you leave the United States and let's say take up somewhat permanent residence in Canada, while you can hold on to that green card for a temporary period of time, at some point, either that green card will expire and you can't renew it, or, Border Patrol of the U.S. may say you're not entitled to that anymore. So if you relinquish that green card, or if it's taken from you, if you've been a U.S. person filing for more than 7 of the last 15 years as a green card holder, then you're what's called a long-term permanent resident, and then you're actually subject to an exit tax similar to if you revoked your U.S. citizenship. And so now you have a deemed disposition of your assets. You potentially have some U.S. tax to pay. More importantly, down the road, when you pass away, if your beneficiaries or heirs, or if during your life, if you make gifts to U.S. persons, then, and there's been a law about 16 years on this, some of the regulations just got approved over the last 6 months, there's a transfer tax, because what Congress has said is, well, if you relinquish your green card or if you revoke your citizenship, you're probably doing that to avoid estate or death tax. And so we're going to actually tax your heirs and your beneficiaries and anyone who receives a gift from you at a rate of 40% of the value of what they receive. So that's a significant tax that doesn't happen when you necessarily revoke the green card, but when you pass away. And so really careful and deliberate planning and discussion is always recommended, around green card holders if they aren't going to remain in the United States.
I think the key number that you put out there was the 8 years out of, I think it's 8 out of 15 years.
That's
Right?
right.
So you,
Yeah,
you
eight or more.
really need to be mindful of your plans. If you are thinking seriously of making your stay not permanent, then you want to be mindful of how much wealth have you accumulated over the time you've been in the U.S. and how long you really want to stay. And I don't know how you feel about this. Obviously, I know my lane, but I would suggest that becoming a U.S. citizen may be more cost effective than remaining a green card person.
It can help with the transition. It may not be a perfect solution, but the stability you have as a U.S. citizen doesn't necessarily exist with a green card if you're not living in the United States. And oftentimes that can make a lot of sense. And this is more of an immigration question, but obtaining that citizenship is something you probably want to consider before you leave the United States. Exactly. I don't know how easy it is to do after the fact. I suspect it's quite difficult.
I think I've had this conversation with more than one client, couple, family, that, are thinking about moving back to Canada, and they don't know what their future is lies for them. But, they've got kids in the U.S. that were born in the U.S. and now they want to go back to Canada. There's a big pull for them to move back closer to grandma and grandpa and all of that. And, they've been down here long enough now that, becoming a U.S. citizen before they move back to Canada just makes sense economically for them. Even if they have to refile to the IRS every year going forward, it's still less painful than being subject to the.
If these what are called these covered expatriate rules, if these exit tax rules impact you, then that can be one solution. Before people jump to that, I'd say there's probably a half dozen different strategies to handle green cards, and this is, part of why, good tax planning, good consultation can really help a family.
Well, and that's why we have you here and to help us out. Steven, what a great conversation. I'm really glad we had you on. Before we wrap up this episode of the podcast, just want to pick your brain just a little bit here. What advice would you give to someone who might be tackling, I'm going to call it the cross-border tax matrix for the first time?
Sure. Well, and I think it's good advice. And, one of the concerns I have with what's available, for all, decades, we've been able to kind of use the internet and search things. And there's lots more techniques with artificial intelligence to get those answers. And my concerns are always, you may be able to get answers to the questions you're asking. But the thing I think people run into time and time again is, what if I'm not getting the answers to the questions that I don't know to ask? Because U.S. tax law, Canadian tax law, incredibly complicated when you get into the cross-border environment, when you're dealing with both countries at the same time. Both countries will treat income gains, deductions, dates, moves. They'll treat things differently. And it's understanding the difference and how you make sure that you coordinate and make your tax plan effective and efficient. And I always talk to clients to say, whenever you have a consultation with us, then I always suggest to people that, before you make that big decision of buying an asset or setting up a business or moving from one country to the other, to spend that time to get that funding and fees, to get that advice beforehand is going to go a long way to making sure you get an efficient and effective tax plan. So I think that's kind of one of the biggest things, is just make sure you get the advice. Andersen is a firm, and I do this kind of planning and this kind of consultation quite often, and happy to help families and business entrepreneurs doing that.
And we all, as I always say, and maybe more than I should, but those who fail to plan to fail. And so working with someone like yourself is a great way of making sure that you avoid some of these potholes. For those watching on our website, they're going to be able to see all of your contact information on the screen. But for those who are listening on, Spotify, Apple, however they listen to our podcast, could you share with us what is the best way for them to contact you directly if they want to get a hold of you?
Absolutely. So our website's probably the greatest place. So if you wanted to Google Andersen Tax, Steven Flynn, you would come up to the biography page. And so that would give my email address. I'll repeat it, steven.flynn@ca.andersen.com. That's probably the best way to get a hold of me. And if I can help you, great. If one of my team members across Western Canada in our offices can help you. We'll get you connected to the right place.
Steven, thanks very much for making time for us today. It was a great conversation. Look forward to having you back again. Maybe after you come up for air sometime in the summertime after you get the U.S. tax deadline, the Canadian tax deadline, and then probably a much needed vacation, a chance to breathe. We'll circle back to you. Thanks a lot for joining us today.
Wayne, thanks for the opportunity. Great to talk to you again.
Steven Flynn joined us today from Vancouver, British Columbia. He is a partner, a CPA, and a CA with Andersen. I look forward to bringing you to the 3 Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive notification of when our latest podcast has been posted, please click on the notifications bell. Lastly, to schedule an online consultation with me to discuss your wealth management needs, please click on the link in the description box below. That is www.onecapital.com/meet with Wayne. Thank you, and we will see you soon.